If you're watching the digital asset market right now, you're looking at a picture that it refuses to make sense. It is absolutely full of contradiction.
It really is.
We have Bitcoin, which seems to be completely stalled out, stuck around that $90,000 mark. It can't seem to capitalize on any of the global instability.
Right. And yet, if you look just beneath the surface, you see institutional money moving with some really intense conviction into very specific assets and brand new infrastructure.
And that's the core tension we're diving into today.
Exactly. We've pulled together a great stack of sources, some detailed market briefs, technical analyses, and even some insider reports on what Wall Street is actually building behind the scenes.
So our mission isn't just to read the headlines.
No, not at all. It's to figure out the consequences of these contradictory flows. I mean, is the entire market just consolidating before a massive bull run, or are we truly watching the future of finance split into two fundamentally different parallel paths?
And since we're starting with this massive contradiction, let's just address the biggest question right up front for you. If global uncertainty is rising, and our sources confirm it is, why exactly is Bitcoin failing to act as that ultimate safe haven asset right now?
Let's get right to the data on that.
Okay, so let's unpack this. We had what should have been a huge price shock. Michael Saylor announces he bought $1.25 billion worth of BTC.
A massive number.
In the past, that kind of purchase was a rocket booster. But this time, the price actually slipped right after, and Bitcoin is still stuck.
So why did that news have the effect of like an aspirin tablet instead of a shockwave?
Well, what our sources are highlighting is that classic sell the news dynamic, but it's magnified by institutional clarity.
What do you mean by clarity?
I mean, once that announced purchase is done, that huge predictable buying support just vanishes. And that's immediately coupled with very real, very organized selling pressure from the institutional side.
You're talking about the ETF flows? Exactly. We've just logged 3 straight days of negative ETF flows. But the crucial part is this isn't random retail panic.
Right.
The institutional selling is identifiable. We've seen BlackRock-linked wallets sending significant amounts of BTC over to Coinbase.
And the consensus is that's for selling.
The consensus is that it's preparation for selling, likely to rebalance portfolios or just take some profits. That is a powerful, direct headwind that's just neutralizing all of Saylor's enthusiasm.
It's fascinating, though, to connect that micro pressure to the broader macro environment, because the failure to act as a safe haven is the real paradox here.
It is. Bitcoin is designed to shine when traditional markets look shaky.
And they are undeniably shaky right now.
Oh, absolutely. We have rising domestic uncertainty in the U.S. We've seen a criminal investigation opened into Fed Chair Jerome Powell, which, that makes sophisticated investors very nervous about stability at the highest level.
And internationally.
Tensions are spiking. U.S. activity around Venezuela, a renewed political focus on Greenland. I mean, this is the exact scenario Bitcoin was supposedly built for.
But the data is telling a completely different story about where the capital is actually flowing.
It is. Instead of rushing into decentralized digital assets, investors they're seeking shelter in the old guard. Traditional safe havens. Gold and silver are hitting new highs. Even the S&P 500 is showing incredible resilience.
So Bitcoin is lagging.
It's lacking. It's failing to fulfill that promise of being a digital safe haven, which suggests that, at least for the near term, big money still sees it as a risk-on asset, not a hedge.
So if it's trapped in this range, what's the immediate outlook? Does this consolidation mean a breakout is coming?
The consensus is that this range won't last long. A larger move, either up or down, is expected within the next 1 to 3 weeks.
So which way is it leaning?
Well, given the current institutional selling and the fact that macro anxiety isn't translating into demand, the short-term leaning is still slightly bearish. We are consolidating, yes, but the pressure is definitely pushing down.
To dig a little deeper into that pressure, let's pivot and look at the market structure, specifically through the lens of Benjamin Cowen's technical analysis. He offers a great challenge to this idea that we're already in some kind of sustained bull market.
Cowen's analysis is so vital because it really makes us question what we think we're seeing on the charts. His core argument is all about the bull market support band, the BMSB.
Right, and a lot of retail investors see the price, touch that band, and they think, okay, this is it, lift off. They see it as support.
They do, but he argues it should be viewed as resistance right now. And there's a historical precedent for that.
What's that precedent?
Well, we need to remember that in these mid-cycle years or after a long consolidation, a clean break above a major resistance level like that It rarely happens on the first try.
So it bumps its head a few times
Yeah.
first.
Exactly. Historically, a genuine uptrend follows either a much longer, more grueling period of sideways consolidation below that band, or maybe even dropping to hit new lower lows to really shake out the weak hands.
The current price action is struggling right at that resistance line.
Which suggests we are still firmly in a consolidation phase. The chart might look visually similar to the start of a massive breakout, but the underlying psychology is it's totally different.
How so?
Cowan points out a crucial indicator. The previous market top happened during a period of generalized apathy, not euphoria.
Apathy. That's an interesting word for it.
It is. If you look at the on-chain data, retail participation and speculation are still extremely low. There isn't that kind of, froth or speculative fervor you need to sustain a real aggressive breakout.
And the risk appetite across the whole market sort of confirms that skepticism, doesn't it?
It absolutely does. We see Bitcoin leading, but the altcoin complex is, for the most part, lagging significantly. If investors were confident in a long-term bull run, you'd see capital flowing aggressively out of Bitcoin and into those higher risk, higher reward alts.
But the money is staying put in BTC.
Which tells you there's a limited, very cautious risk appetite overall.
That's a really necessary perspective. So the takeaway here is that any short-term rallies are probably just part of a broader late-cycle range. We're not seeing the psychological setup for a massive new bull run.
Not yet. Not yet. It needs a huge trigger.
Now, if short-term speculation is stalling out and risk appetite is constrained, let's look at the drivers that are creating long-term non-speculative value. We saw a major geopolitical event that created this incredible aha moment about the need for true decentralization.
Yeah, the price of censorship.
Exactly.
This is where global events just draw a clean, bright line between centralized and decentralized assets. The setup was Venezuela attempting to evade sanctions. They were moving billions in oil money through crypto.
And they were mostly using Tether on the Tron network, right?
Yeah.
Because it was fast and outside the traditional system.
It was fast, it was cheap, and it was outside the reach of the SWIFT system. And for a time, it worked. They were bypassing those traditional financial gates entirely.
But our sources detailed the swift consequences once the U.S. brought pressure down on Tether.
The consequences were almost instantaneous. On January 11th, 2026, Tether froze $182 million in USDT across 5 separate Tron wallets.
Wow.
One of the largest single freezes they have ever executed. And that event crystallized a critical lesson. Centralized stablecoins are not neutral money.
They're run by companies.
They're run by companies with compliance mandates, they have bosses, they have rules, and when a government applies pressure, they have the technical ability to freeze your assets remotely and instantly. You lose sovereignty.
And the market reaction was immediate.
Immediate and highly instructive.
Yeah.
Suddenly, the need for a truly censorship-resistant network became, urgent and tangible. It wasn't just some academic theory anymore.
And that's why we saw Monero jump.
That's exactly why Monero jumped to new all-time highs over that weekend. That price surge wasn't driven by speculation. It was driven by clarified utility.
Because Monero is a network with no owner, no off switch.
And crucially, no centralized blacklist. It uses sophisticated cryptography to hide all the critical details: who's sending, who's receiving, how much is moving. If you can't see the transaction and there's no central company running the protocol, you simply cannot freeze the assets.
So for you, the listener, if you're interested in true ownership and privacy, this event proved that value beyond just price. The long-term demand for absolute financial sovereignty was just validated by real-world geopolitics.
It really was, and it's the perfect counterpoint to the institutional movement we're about to discuss.
Okay, moving from that sovereignty narrative to the predictability narrative. Let's shift focus to where major institutions are actively investing in building infrastructure. Before we dive into the core platform, let's just run through some fast facts that show where the smart money is moving.
Sure. You've got Standard Chartered, for example, making a very specific market call. They're predicting Ethereum is set to outperform Bitcoin in 2026.
And what are they basing that on?
They cite 3 main drivers: stablecoins, mass asset tokenization, and just rising on-chain activity on that specific network. It's really a bet on utility over simply being digital gold.
And that conviction is being backed up with cash. You have players like BitMine adding over 24,000 ETH in a single week.
Yeah, that pushes their total institutional holdings up close to 4.2 million ETH. That is conviction built on utility, not just pure speculation.
And the infrastructure to support all this is growing in parallel. Crypto custodian BitGo just filed for a significant U.S. IPO, trying to raise $201 million.
And that just reflects the growing institutional demand, not just for the assets themselves, but for secure, regulated, and compliant custody for those assets. They need a partner that plays by the traditional rules.
We should probably quickly note that $180 million BTC moved by a Satoshi-era whale from 2010. It caused a stir, but ultimately no major panic.
Right, the market just absorbed it, which, it confirms that while the market is consolidating, the underlying structure is deep and resilient.
Okay, let's spend the rest of our time here on what feels like the most important development in institutional infrastructure, because it really highlights the other side of this split we're talking about, the Canton network.
The Wall Street chain, as many are calling it.
So tell us what Canton is, based on that summary from founder Yuval Ruz, and why it's even necessary if we already have something like Ethereum.
So Canton is specialized on-chain infrastructure built exclusively for institutional finance. Its sole purpose is to bring real-world financial assets, regulated things like U.S. Treasuries, stocks, derivatives on-chain.
So this is not for retail DeFi.
Absolutely not. This is for the major players. Banks, market infrastructure providers, licensed custodians.
And who is actually using it?
We're already seeing significant adoption and testing. Broadridge is using it for treasury collateral movements. The DTCC is running tokenization pilots on it, and firms like JP Morgan are heavily involved. This is where traditional finance is starting to move billions in real regulated value.
And the key difference from a public chain like Monero or even Ethereum has to be privacy and compliance, right?
100%. For them, compliance and privacy aren't nice-to-haves. They are mandatory. Traditional finance cannot operate on a public ledger where every transaction is visible to everyone.
So how does Canton solve that?
With Canton, transaction details are only visible to the involved authorized parties. Plus, the network connects multiple independent subledgers that can talk to each other directly without all the security risks you get with public bridges or wrapped assets.
And that need for predictability, it seems to extend to the operational costs too, judging by the design of their CC token.
It does. The CC token is structured purely around utility and stability, not volatile speculation. It's used to pay network fees and secure the coordination between the subledgers. But here's the crucial part for institutions.
What's that?
Transaction costs are priced in US dollars, not in a volatile token.
So it's almost like an operating fee. Like paying a predictable rate for utility, not betting on a volatile commodity.
That is the perfect analogy. An institution must know its operational costs in advance to run a business. This mechanism totally eliminates the volatility risk that's just inherent in public crypto networks.
And the tokenomics reinforce that.
They do. The CC tokens are burned when used for fees, and they're reminted when usage is low. So the value is tied directly to verifiable, regulated network activity, not to retail hype. It's a highly regulated, predictable tool designed for the existing financial system.
This has been a tremendously insightful deep dive. I mean, we started by seeing this short-term resistance and institutional selling pressure stalling out Bitcoin, but then you quickly realize this stall is allowing two completely different value propositions to solidify.
That's the synthesis. The market is clearly bifurcating. It's splitting. On one side, you have these institutional giants building compliant, predictable, USD-costed infrastructure for regulated assets. That's the Canton model.
The system optimized for compliance.
Exactly. And on the other side, you have this growing, urgent, and globally validated demand for absolute sovereignty and censorship resistance. That is the Monero narrative, proven by real-world conflict.
The system optimized for freedom.
So yeah, we have two emerging digital financial systems. One is built for compliance and predictable costs, and the other is built for freedom and sovereignty, which, it raises a really interesting question you should be mulling over.
Which is, does this mean the very concept of a single crypto market is now obsolete? If we're looking at two parallel digital financial systems emerging, which system, the compliant institutional one or the free sovereign one, will ultimately capture the most long-term value and why? That's the deep dive for next time.